So, welcome to another video of ours. Today we're gonna discuss another stock.
Today, like 5 minutes later.
But yeah, this is Visa, and something that's dear to your heart instead of Meta for mine. So basically, we're gonna run you through our stock analysis tool, and you will see how it works. You'll see what value you can get from it, and then we'll see what it potentially will be worth, and then we mean Visa. So let's jump into it. So first, as always, and again, we're trying to run through this a bit more, make it a bit more concise. So if you want to know more about how this tool actually works, then you can check out all the videos, and I'll also make some instruction videos in the future.
And if you want us to make, let's say, more detailed analyses or whatever, just let us know in the comments. We'll have a look. Maybe we're gonna make some deep dives into certain companies. For example, what we invest in, what we like.
Exactly. So yeah, fun stuff. So indeed, let us know. And also, if you want, you can subscribe, and you can hit a like and comment.
Or a dislike or whatever.
Exactly. We're trying to be as engaging as possible. So just leave whatever you want. So basically, we're starting. Again, the summary, right? Visa summary statistics, all fine and dandy. Just your welcome into this part of the tool. So we see in full greens on the foundation: revenue growth, net income growth, free cash flow growth, long-term debt covered. Basically, meaning that if they would like to pay off all their debt in one go, they are able to do it. And especially in this climate where there's a lot of uncertainty, it's fine to have at least that foundation.
Yep.
They have share buybacks, which is also something you really like to see. Whenever they buy back shares, there are less shares circulating in the market, meaning that your value of the share is actually going up. You don't want to see this the other way around. Then a dividend growth of 13.74%.
This is very nice, yeah.
Well, what is their dividend yield?
Yeah, but that's the thing, because they pay such a small dividend, and their payout ratio is like only 20%. So it's for them, they can afford to increase their dividend quite substantially. Yeah.
This is the first time I saw double digits with dividend growth, so that's why I just wanted to come back to it.
That's what it means to have a sustainable moat, and then have a great company in front of us. Yeah.
Well, so that's already a good start, right?
Yeah.
So, we can just skip this, but again, as we said, like free cash flow growth, you can check it over here, the long-term debt.
And as you can see, it's also pretty much consistent in terms of the free cash flow growth. And you can see also the same with revenue. It's just great to see. And also, what's very fun to watch as well, research and development expenses, zero.
Zeros across the board. Yeah,
zero. They are really able to increase their revenues pretty much without spending additional expenses in terms of maintaining, let's say, their card network or bringing in some new developments into the, let's say, their payment ecosystem or whatever. So that's just great. Yeah. That's
really good. So that's also something that we'll see now. So basically, these statistics are based on a book, which is linked in the description below. And it's written by the daughter-in-law of Warren Buffett. And basically what they think he looks at. And they just highlight some of his holdings and then with these ratios. Basically, you want to have the net earnings ratios above 20%, interest expense ratio as low to zero as possible, research and development ratio, you want to have it as low as possible, selling general as low as possible, depreciation as low as possible, free cash flow, shares outstanding,
it's just basically all green all the way.
Exactly,
it's just great
really
to
good.
See,
So here for net earnings ratio, we can see it's also like what you said before, with the free cash flow, it's really consistent, 48-51, 48-50, 50.
And this is great. This is really great, actually. When you have above 50% mark, every single year when you hit that, it's just, you gotta say that it's definitely a very sustainable company with, like an arsenal of great, let's say, businesses behind it. So,
so that's something really positive. Interest expense ratio very low. It's something really good to see. So for, like you said, this has to do with the moat, right? So basically, what this means is, they don't need to invest in building more products. They have the product, it works, and they're like, we have such a good company, such a strong a competitive advantage. We don't need to invest more, and that's also what they're not doing. They're not investing.
And also on top of that, if you can see, like for example, in comparison to Meta, right, where they had a selling and general expense ratio of, what was it, 50 in 2022, if I recall correctly. Look at Visa. 10%, 13%, 11%, this is nothing. That just means pretty much nothing in comparison to the rest.
They're probably printing flyers.
Yeah, but
for banks and
they print cards instead. For people to use. Yeah.
So again, for depreciation, this you would expect low for a service company, right?
Yeah, because again, they do not have. It's not a asset-heavy business.
Yeah.
They just print cards. They just give it to people, and the way how they make money is just by collecting fees, credit card fees, debit. You know.
And this is also why, for example, Amex is different in comparison to Visa, because Amex actually wants you to pay for wants you to completely pay off the card. They don't want your interest. They want their high-end clientele, so that the cards in which the stores that have the Amex cards are high-end retailers, and they pay a hefty percentage on every transactions compared to, for example, Visa.
Yeah. Similar like to MasterCard, they got a pretty much similar business model and everything, but Visa still holds the biggest share on the market in the world. And also the good thing is, if we could go back to the revenue, let's say, part of things, still I think, if I recall correctly, 40% of transactions globally happen still with cash. So it means there's still a lot of room in terms of growth for Visa to go further. Of course, we face competition mainly with MasterCard and some local payment brands, because, so the thing is, just a little bit of a background, let's say I work in the cybersecurity industry in the payment domain, so I kind of understand, let's say, what's going on in that department. And nowadays, more and more payment brands are appearing locally. For example, in India, RuPay, let's say in China, there's another one coming up in Europe, actually, the Payconic, maybe you've heard of it. So it's one of the, actually, I think it's a part of ING Bank, the Dutch one. So they are developing because like even governments try to remove, let's say, the over-dependency on American, let's say, businesses for the payments. But then it's way long journey. So the mode for Visa and for MasterCard, of course, it's just insane.
Yeah.
Yeah.
So that's again green across the board, really good.
Yeah.
So free cash flow growth. So they have been picking up that pace in the last 2 years. Revenue growth as well is just good to see that they're developing, and these are all, of course, COVID. The years that COVID happened.
Makes sense, yeah.
Net earnings growth, but again, it's just all stable.
And also to keep in mind, even though it was COVID times, right? So it would mean that everybody would just stop, like, buying things, right? Still, let's say 20% of decrease in free cash flow and only 5% decrease in revenue growth. Sure. That's nothing.
People still buy it, and I think you can also see it, for example, here with the free cash flow growth. So this year COVID happened, right?
Yep.
But then after, like, if they're really into like collecting interest, I mean, I bet that people the year after COVID had maybe more difficult time to have a stable income, so they would defaulting on the credit cards, and then there's your interest payment, let's say.
Like at the end of the day, people will still be buying at least necessities, right? And the more people use cards for that purpose, including credit cards, Visa will still be able to collect their fee at the end of the day, right? As long as people are not paying with cash, and as long as they're still, keeping with the purchasing power all over the world, Visa is still going to profit. So, yeah.
Well, so this is all positive, like I said, really stable numbers. So, for again, your section, the Fundsmith.
Yeah, again, saying the same thing. Fundsmith, Terry Smith is the big investor in UK. He's pretty much just British Warren Buffett. But this guy has his own metrics, what he checks in terms of when he's looking for the stocks, which are return on capital employed. So pretty much how much money the company gets when we invest $1 into the operations. Gross profit margin, operating profit margin, again, same story. Cash conversion, and then interest coverage. And as you can see, it's green all the way. Yeah. It's insane. If a company is able to make 50 cents on every single dollar they're making a year, okay, the lowest was 39.
But still, it's just...
It's unimaginable, to be honest.
Exactly.
Yeah,
it's crazy.
So you can definitely say that the mode of Visa is just solid. It's just rock solid. Yeah. At least in the nearest future, even though a lot of people were saying, okay, there's going to be cryptos, people are going to be using cryptos for buying, certain goods and services. Visa was also one of them who actually partnered with Coinbase, for example, to actually connect these transactions. So at the end of the day, we are even still able to tap into such, developments. Yeah. So,
Yeah, solid.
Yeah, exactly.
So do you want to tackle the assumptions? Because you're really into this company, so I think this is better for you to tackle.
Yeah, sure. So the thing is, when it gets to Visa, what you got to keep in mind is, for example, our understanding, we kind of did, let's say, our due diligence. I also was investor in Visa in 2022. So I actually was buying that when it was in the ballpark of $170, and I sold it when it was like $230 recently. So the thing is, let's say if we're talking about the future growth, I don't even need to go to, let's say, for example, stock analysis. We can just even go to our tool. Yeah. We can put, let's say, in terms of free cash flow growth, somewhere in terms of, let's say, 13%. Yeah. I would say that assumption is rather even small, because if, let's say, the biggest economies, like for example in China and US and Europe, they're going to do well, right? That increase is going to be even bigger, right? Yeah. But then again, you also got to keep in mind that there might be some turmoil. So you can check out, for example, our third video where we talk about the macroeconomics. Yeah. So even I would leave 15 in here. It's fine. So P ratio. So let's have a look. So if we go to Visa, what do we see? So we got somewhere lows of.
Yeah, you still need to put it like on. Let me just.
Yeah, but it's. Yeah, you can put for past 5 years. Yeah.
Clarity.
So the lows of 28, which is also very nice, and the highs of 50s. I would put, if we let's say assume that there's going to be some issues in the future, and then there might be some local competition for Visa, right? We can put maybe somewhere 22, let's say 45. I think that's rather reasonable. Okay. So we go back to our tool, and then we put. Yep.
So it's a 45.
45, yes, and then we put here. I would even put 25. I think it's rather solid. And then again, as you can see, it's just because of the fact that it has such great financials, such a strong moat. It's even okay to pay premium. So that's also the thing to consider. Like, there are some of the companies where you can actually put margin of safety of even more than 20%, as we usually do, right? For some of them, you can even just pay a premium because it's such a great company, and then at some point, it's okay to even overpay 15%. It's similar, like, for example, if you're going to go shopping, and then, for example, you want to buy a chocolate bar, right? You can buy Hershey's, which is maybe like what, $1, let's say, right? But if you want a better quality chocolate, right, then you're maybe gonna look for some Swiss, some better brand. But then again, you'll just have to pay a little bit more, right? So it's just all up to your preference. What do you actually want from the investment, right? So I would even personally put like nothing in the margin of safety in here. And then in terms of the discount cash flow, I would even put 20 years, just out of curiosity, just to see how let's say, realistic.
And that's also because they really don't develop per se. It's not like they are hinging on something that needs to come out next year. It's just the product. It's there.
You just gotta maintain the network. Yeah, that's the only thing. So what do we got? Right now it costs $245, and then we got something around 230, right?
Yeah.
I would say, because I was also thinking about it, because I knew that we're gonna film Visa, and I was actually even thinking to start building a position on Visa. The only concern of mine is that we still got our S&P shorts, and that's still something which is work in progress. So I believe it still can go down a little bit. But then again, if you do not want to be greedy, if you want to have, for example, a great company, you can consider Visa.
And again, you can also just start building the position, and just when it goes down, your dollar cost average with it. I mean, if you trust the company with this mode, for example, it's
please keep in mind, again, not a financial advice. It's just our experience and, let's say, our thoughts about Visa. We did our due diligence. If you're interested, for example, to look into it further, you can do your homework. You can check their annual reports, or, for example, if you want us to do the deeper dive, we can always do that.
Yeah, just make sure to let us know in the comments.
Yeah. And what you do, Vilas, you can, if you like the company, for example, you can hit the save button if you would like to use our tool in the future, and then it's going to save in your lovely watch list, and then you can maybe even make some comments and notes for yourself, so you can just track the performance.
And something you just showed me today is the
Yeah, and the valuation tracker, so you can also see, for example, the ballpark of, let's say, when the stock is completely undervalued and it's just a bargain, or it's very overvalued, and maybe you can consider, let's say, quitting the position.
Yeah, exactly.
But yeah, it's all up to you at the end of the day.
And then you can just get this tool if you go to 930.com. It's very easy. You go to get access today. And for the first 15 people, it will be $1 to get the sheets. You can just use your preferred payment method. And
Visa is also included in
that. And within a short while, you actually get the tool in your inbox. Yep. It will be set up, and you can start using it right away. Yep. And then afterwards, it's gonna be just $15 flat fee for everyone to use it, because our whole vision is to make value investing accessible for everyone, make it as easy as possible. So that's why $15, nothing more, nothing less, no subscriptions, just plain fee. Yep. And then I'm thanking you, Kirill, for again sticking with me here. Thank you for watching. Again, please let us know if you want to see something else in the future. If you want us to dive into a company or do a deep dive, let us know. Yep. Have a good one.